Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinski, the former practice group leader for 25 years, and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'll be moderating today's program. For those of you who want more information about the world of consumer finance, don't forget to consult our blog, which also goes by the name of Consumer Finance Monitor. We've hosted the blog since July 21, 2011, when the CFPB became operational, so there's a lot of relevant industry content there. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog, or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or wherever you obtain your podcast programs. Also, please let us know if you have any ideas for any other topic that we should consider covering, or any speakers that we should consider as guests on our show. We're very proud to report that a company called Million Podcasts, which is a podcast database service, has ranked our Consumer Finance Monitor in the top 25 among hundreds of financial services podcasts nationally. The service recently published a list of the top 100 financial services podcasts. Consumer Finance Monitor also ranked as the top law firm podcast among the top 100 financial services podcasts, as well as the only podcast that's focused on consumer financial services, not just financial services in general. So let me tell you a little bit about the program today. This is a topic that we haven't covered in ages. In fact, we've covered the topic on numerous occasions on our blog, but we've never actually done a podcast about it. And what I'm referring to is the Consumer Complaint Portal and the Consumer Complaint process at the CFPB. And a lot of what has gone on that Consumer Complaint Portal, while there is some public information available, much of it is shrouded in secrecy. The guests that I have on today's program, however, were, with permission of the CFPB, able to gain access to a lot of confidential data, the data that the public doesn't see, but is internal to those who work at the CFPB. And our speakers today, who I will introduce in a moment, have done an incredible study of just terrific research covering a decade of complaints that were submitted to the CFPB, with the focus being on the level of monetary restitution that people have received. And what are the variables? After looking at the data, what are the factors that increase the likelihood that the consumer is going to get a decent amount of restitution. And our authors have written a brand new working paper. This is work that's been done this year because it covers a 10-year period ending at the end of last year. It's entitled The Hidden Costs of Financial Services, Consumer Complaints, and Financial Restitution. It's not yet been published in a law review. However, it is available on the SSRN network, which is a network that's used by professors of all types, including law professors and those to teach in business school, where they make their articles available often in a very early stage before they've reached the stage of being published in a journal. So that gets me to our speakers today, and I'm going to introduce them right now. Charlotte Handler is an assistant professor of finance at the Cox School of Business of Southern Methodist University, which we often refer to as SMU. Her research focuses on how digitalization is reshaping traditional banking and on the well-being and negotiating power of consumers in an ever-evolving financial sector. She holds a doctorate in finance from the Carroll School of Management at Boston College. And before earning her doctorate, her PhD, she worked at the European Central Bank in the Market Infrastructure and Payments Division. She also holds a joint master's degree in financial economics from Bocconi University, I hope I pronounced that right, and HEC Paris. So, Charlotte, absolutely delighted to have you as a guest on our program today to talk about this fantastic research which you have done along with your co-author, who I will introduce in a moment.
Thank you, Alan. It's a pleasure to be here. Looking forward to talk about the research.
And let me now introduce Professor Raleigh Heimer at the W.P. Carey School of Business at Arizona State University. He's a leading expert on financial markets and household finance. His research focuses on how individuals make decisions in risky asset and debt markets, decisions that shape their financial security over a lifetime. He's especially well known for groundbreaking work connecting social media to trading behavior and for examining how mistaken beliefs can distort life cycle financial planning. Raleigh also studies the legal and regulatory frameworks that shape real estate and mortgage markets, with particular interest in how these institutions impact household well-being. His work has been recognized with awards like the Dimensional Fund Advisors Distinguished Paper Award at the Journal of Finance and the Rising Scholar Award from the Review of Financial Studies. In addition, Raleigh brings real-world policy experience from his time at the Federal Reserve Board and from the Consumer Financial Protection Bureau, where he served as a senior advisor for research and policy. He is a trusted voice in both asset management in that world and in litigation involving digital assets and financial regulation. Raleigh, a very warm welcome to you as well.
Alan, thanks so much for having us on the program to talk about our research. Excited to chat with you.
My pleasure. And this is a subject of great interest to me because I have followed the CFPB from its inception and when they launched their complaint portal. And in fact, at one time, we had hired as a lawyer in our firm somebody who was assigned to the complaint portal. So we got involved really from the very beginning. So before we dive into the details of your paper, can you tell us a bit about why this topic matters to you, Charlotte? Why the in-depth CFPB consumer complaint study in the first place?
Yeah, so absolutely. So the way we thought about the Consumer Financial Protection Bureau complaint system and data is by looking at our own experience first. So think about those times where suddenly you see an overcharge in your bank account, an unexpected fee or something like that. And then you end up contacting your bank and spending endless time on customer service, on the telephone, via email, scheduling appointments. And then if you're lucky at the end of the whole process, you do get a resolution, but sometimes you're still left hanging or not fully satisfied. So what if you know about of the CFPB? In that case, you can actually make your voice heard there instead of directly with the bank or after you tried with the bank. And the complaint system is very easy. It's online. You can do it at your own pace, your own time. And it also entails some peace of mind to a certain extent because you know you have an agency behind looking at it. And also technically that agency should have your back. It's a Consumer Financial Protection Bureau. And this is how we got interested in the data in the first place. The idea is that the more people think about the CFPB and use this complaint portal, the more the data coming out of this complaint portal become a goldmine. Because the complaints are not just daily grievances. Sometimes they are, but most of the time they're not. At the core, they could reflect real consumer disputes. And so in that case, you start looking at the data a bit differently. You start thinking, well, this is our opportunity to see what would happen in a consumer dispute, having access to millions of them. Whereas usually everything stays within the institution that it is being disputed. And that's how we got interested in the data. So while the CFPB tends to look at this data to understand if at times something is broken in the system to then initiate some enforcement actions, we take this data more as a laboratory to analyze the disputes that are usually kept as private information to financial service providers. And that's how we get to the data in the first place, the angle that we take.
And thank you for answering my question. I take it just to clear up some uncertainty that exists out in the marketplace. While there have definitely been efforts of the new administration to minimize the CFPB, that is, they want to reduce the headcount by a huge amount, down from about 750 employees down to about 250. That's all tied up in litigation right now. And they've come out with new supervision and enforcement policies that are dramatically different from those that existed under former director Rohit Chopra. The complaint portal is about the only area right now, the CFPB, that still seems to be functioning. Am I right?
Yes, the complaint portal is still up and running, went down for a brief amount of time, but then was pressured back up. And it seems to be up and running also in the amount of the complaints that it still receives.
So, as I understand it, you basically use the CFPB complaint data as a proxy for consumer disputes in the entire industry. Can you give us a few examples of what these complaints might look like, Raleigh?
Before giving a few examples, let me describe the complaint process in a way that will resonate with your audience. Think about the goods that you buy in any store. Let's suppose that you, for example, bought a new washing machine and it has some damage. You would immediately call the company and they would come out and look at it, and then you might ask for a refund. But financial services are quite different. Instead, what they are is the good is actually a contractual service over money rather than a tangible item. And some examples of this would include for a recent consumer in Kansas who identified a $2,400 transaction on their bank account that was labeled money transfer adjustment, but one that they themselves did not authorize. So they were able to use the consumer complaint bureau function in order to receive a refund on this transaction. Another example is a consumer from Michigan who had an issue with their auto insurance and their auto loan. Their gap insurance provider was supposed to have given them a refund of $1,200, but that didn't show up on their auto loan account. And so they're able to use the complaint function at the CFPB to help get that money posted to their auto loan.
In the paper, you mostly focus on the likelihood of a complaint resulting in financial restitution. The title of your paper is called The Hidden Costs of Financial Services, Consumer Complaints and Financial Restitution. First of all, what do you mean by hidden costs, Raleigh?
Great question, Alan. The reason these are hidden costs is because consumers do not necessarily expect to have errors with their financial services when they initiated them. These are issues that they have to address later on, and they're difficult to quantify and factor in ex ante. So therefore, the goal of our paper is to attempt to be the first large-scale study of these hidden costs that quantify how much financial restitution consumers might receive, and then also to look into the determinants of financial restitution, thanks specifically to confidential data from the CFPB complaint system.
Right. You mentioned confidential data. Were they pivotal in better understanding the mechanisms behind the resolution of these consumer disputes?
Yes, absolutely. They were essential. So there's a big difference in the amount of information that the CFPB discloses to the public on the complaint portal and what they actually have access and can keep track of. Especially if you're familiar with the public data. For example, you have the name of the entity that is being complained about, you have the product, but you only have the text of the complaint, so how the consumer expressed the situation they are facing and the issues that they're having with the financial product, only if the consumer itself decides to make it publicly available. While in the private version of the data, you actually have the full narrative for each and every complaint filed, together with an additional field that describes what would be the desired resolution. So the filer can then just write what are they expecting the company and the CFPB to do in this situation. And that's very interesting, helps us understand how people frame their thoughts in these disputes and how they argue about their problems. Also, other data that the CFPB has but is not publicly available is information about the filer attachments. So during the complaint process, the filer can attach some supporting documentation, and we see when and when it doesn't. And we also see the company resources that go into the complaint resolution process. We can get information from the CFPB about when the companies access the CFPB portal to look at their own complaints and manage them. We can see how many complaints each and every employee of the financial service firm has already solved, so kind of a proxy for experience. And very important for what we've introduced so far, we see also the dollar amount linked to every complaint that has been resolved with monetary relief. So we can actually quantify, put a dollar sign to these disputes, and when they're successful, how much money gets transferred from the firm back to the consumer.
Yeah, so Charlotte, just I'm curious, you had to get all this data, access to the data from the CFPB. Were they happy for you to do this research and to turn over that information, or was that a complicated process?
It was complicated from a bureaucracy point of view, but I think there was interest with the people that we were cooperating inside the CFPB with to have this shared playground and skills to dig in deep into questions that we both cared about. So the cooperation felt easy. Of course, it's very highly confidential data that we don't physically possess. We only could access through CFPB-controlled machines. And so half and half, difficult but easy.
Right. So you were, I take it, did you have personal identifiable information, or is that all redacted?
So the CFPB internally has access to personal information as well that is protected in the public version. For example, in the public version, you have the 3-digit zip code of the filer. We had access to the precise address. and also the name, which actually was very important. We'll see later on, because we're able to attach demographics to these filers a bit more easily with the granular information that the CFPB has about them.
Right. Okay. Well, because I know maybe we'll get to it a little bit later, but I was wondering, how you were able to determine the race of the individual, because that's typically not something that's disclosed on a complaint form.
Exactly. That's one of the biggest examples. So we relied on both geographical information and even name and surname information. So we ran algorithms that paired the geographical census tract origin of the filer and the demographics in that tract. So how many people of a certain ethnicity, income bracket, education bracket. And we also use the name and surnames in the case of ethnicity because they are telling of the different ancestral origins of the filer as well. So definitely pivotal as well, very granular filer information the CFPB has.
So let's dig into the disputes. As our listeners well know, the CFPB oversees a wide variety of financial products. Did you find any differences in complaint outcomes depending on the type of product involved, Charlotte?
Yes, we did. Very striking differences, actually. So while on average, we have 7.6% of complaints filed with the CFPB that end up receiving some monetary relief, that end up receiving financial restitution. Across product, the picture has a lot more variation. If you take the products that we all deal with, and we tend to think of them as very straightforward, like bank accounts and credit cards, those had 17% likelihood of being resolved with financial restitution, while complaints on more complicated products like consumer loans, including mortgages, including car loans, including student loans, those had a lower likelihood of ending up receiving financial restitution, around 5%. And it's not only in the likelihood of receiving restitution, it's also in the amount that you on average receive if you make a successful complaint. We have, throughout the sample, an average of around $1,500 of monetary relief if you are successful in your complaint. But then for the easier kind of straightforward products, they get relief more often, but the relief is lower, is around $900 on average. Whereas for consumer loans, we said it happens less often to get the relief, around 5% of the time, but the relief can go up to $1,800, for example. So we see that those products that are easy to understand and straightforward to understand, people are better able to recognize mistakes and argue about them and get relief, but the relief tends to be on the low side. Whereas the products that tend to be more complicated with fine print and long contracts like consumer loans, those tend to receive restitutions less on average, but the restitution amount is higher.
And what about the companies themselves, the ones about whom the consumers have complained? Is there a lot of variation among companies in terms of the likelihood of awarding financial restitution in response to a complaint?
So that's, I think, one of the first things that we noticed that was really striking to us. The product had a lot of variation, but it wasn't really driven by a few bad firms. It's not that a few bad firms tend to receive more complaints, tend to have to award relief more often. As a matter of fact, the amount of variation that the company factor explains, once you take into account the product, is almost nothing. So it's not that we have a lot of firms that are bad and they have to do restitution. There seems to just be general mistakes across all firms that end up happening, but that's not really what drives the restitution likelihood at all here.
Right. Okay. So it's more important about the product and potentially how the consumer relates to it than about there being rogue companies that are, scofflaws, just willy-nilly violating the law. Is that Raleigh? Have I stated that accurately?
That's correct, Alan. And you can think back to the examples of complaints that I already illustrated at the start of the podcast. So the first one, we talked about just a simple account transfer transaction that ended up on somebody's bank account. And it's very easy for people to look at their bank statements and find things that were different than what they had actually done. And so this is a type of product that's somewhat less complex. It's very straightforward. It's just a log of the transactions that you make over the course of a given period of time. On the other hand, if you think about loans that evolve generally over time, these are much more complex financial contracts. And they require a lot more sort of consumer aptitude to understand how to work with them. So the example I gave earlier was a gap insurance payment that was supposed to have been made to somebody's auto loan. What is a gap? What is gap insurance? This is something that many people don't even really know what it is. And so this connects also back to some of the findings that we had in the paper. So when we started to look at the demographics of the individuals that were more likely to receive financial restitution, we tend to find that some of the biggest drivers were people from higher income areas or higher education backgrounds. And so these are the types of individuals who are just generally going to be more able to identify the errors that they have in these more complex financial situations, such as the one I described.
Right. What about racial factors?
Indeed, we also looked at race. As Charlotte had indicated before, we were able to identify the race of individuals in the data by looking at names and their geographies, even though the CFPB doesn't collect this specifically themselves. And so what we generally find that people that we identify as either white or of Asian background were significantly more likely to receive restitution upon filing a complaint with the CFPB.
Okay. So this all sounds very important. Can you walk us through, Raleigh, how those consumer characteristics end up influencing the likelihood of restitution?
That's a great question. So as I mentioned before, we found these differences in demographic backgrounds and how likely people were to receive financial restitution when they file a complaint. And in particular, we found that people from higher income, from more educated areas, from people who are white or Asian background, are more likely to receive restitution when they file complaints. So we also found some significant differences in sort of how they handle the complaint process itself. And so the main differences that we found were that people who from these more higher income backgrounds were often much more likely to do things like request explicit refunds, to use more general language that's more generally related to requesting refunds, so to speak, and also to do things like attach documentation about the problems that they had. And so what's super interesting about this is, in addition to this, you could also think that maybe there's something that's happening from the firm side of this as well. And so it's just the fact that the firms themselves are devoting more resources to these higher income areas. But that's actually not what we found. We found that firms generally treated consumers relatively equally across the different types of complaints. As Charlotte had already mentioned, we were able to look at identifiers for the employees that were responding to complaints at the CFPB. And when we looked at the amount of time that the employees were spending on the complaints, the amount of experience that people had when they were helping resolve complaints, it didn't vary by background within an institution. It was mainly that the consumers had sort of different experiences in their abilities and self-aptitude in terms of being able to navigate this really complex financial system.
So it's interesting that the consumer's ability to navigate the system matters so much. What about regulation? Does oversight from the CFPB change how firms handle disputes and award financial restitution? Because I assume, correct me if I'm wrong, for every complaint that comes in, some human being actually looks at the complaint because that doesn't mean they're going to bring in enforcement action, but if they see the same type of complaint being submitted by a lot of different people against the same company, they're likely to investigate that company. Or if they don't like the way a company is handling their consumer dispute process, they're likely to, let the company know of the unhappiness of the CFPB. So there is a type of supervision or regulation that's involved, and one would think that would matter a great deal in terms of the amount of restitution people get. Well, what did you actually find, Charlotte?
Yeah, so we find that indeed increased supervision from the CFPB does matter. And let me spend a few minutes on this, on how we get there to this result. So we have access not only to the complaint data, but another very important piece of information that's been kept internal so far was one about CFPB company monitoring reviews. So since 2020, circa 2020, the CFPB employees started having review rounds where they select a bunch of financial service firms that are being complained about, and then they randomly draw their complaints, like say 30, 40, 50, 100 complaints over the previous couple of years for each firm, and they analyze in depth how the firm has handled those complaints. And so to each reviewed complaint, they will then attach some quality metrics, like flags on whether or not the company addressed the complaint properly, or flags about whether or not the company response was substantive for the consumer. And based on all these metrics, they then come to an assessment. Is the company way of handling complaints satisfactory, or something needs to be done? And when something needs to be done, what the CFPB started doing is to send that company what they call confidential monitoring report. So the company does not know that they have been reviewed, but they do receive a report, and the report says your complaint answers have been lacking in this many ways, and this is how we would like you to improve. And we have access to this data. So the timing that these reports are sent out, and also the screen complaints, the quality flags that the CFPB has attached to them. And we can basically do two things then with this data. The first is understanding what does the CFPB view as kind of like the gold standard for answering a complaint. And potentially, do we see differences across demographics and products in there too? And the second thing we can do, we can actually test whether increased scrutiny from the CFPB changes the situation, thanks to the reports. Every time a report gets sent out, we can see whether the company does or not take action. So that's what we do in the second part of the paper, indeed.
Okay, so let's start, Charlotte, from the gold standard that you mentioned. We have differences in financial restitution likelihood across demographics in such a scenario?
So the idea is that we can see how well the CFPB deemed the complaint has been answered. And we do see that there is some nudging in a way, because the CFPB thinks that certain complaints across the low income, low education, Black and Hispanic filers, those are handled a bit less well on average. So we see that they are deemed a bit not having received a substantive response as often, or not having been addressed properly a bit more often. And so there seems to be some nudging, but it's actually, our estimates are fairly econometrically weak. And unfortunately, since there is a limited subsection of complaints that is being screened, we're not fully able to assess whether the CFPB thinks that the gap should be just lower or entirely closed, ideally. But we do have a sense that there is this gap, and ideally should be a bit lower, and the CFPB is kind of doing a little bit of nudging here with the reports.
Okay. So, Raleigh, let me ask you this. Differences in financial restitution are at least partly explained by consumer behavior upon filing linked to consumer demographics and how firms react to it. And the Bureau, to a certain extent, would deem preferable this to be less the case. Does increased CFPB scrutiny then weaken this link?
Here's the kicker. What we found is actually quite surprising and the opposite. We found that increased scrutiny by the CFPB, when they sent companies reports about their handling of complaints, actually even though it ended up resulting in companies delivering more financial restitution as they were, intended to have done so, we found that surprisingly, the effect mainly benefited individuals from more higher income, higher education backgrounds. And so it's in some ways, it suggests that there's something a little bit more about a complementary nature between regulation and the consumer's aptitude themselves. It's when you have this sort of this well-functioning financial regulatory setup where it helps consumers get the redress that they merit, the consumers that are better able to navigate both the bureaucracy of the CFPB and their handling of the financial services themselves are the ones that end up benefiting the most from this. And so this heavy-handed regulation that we see in this case ends up, even though it was, in essence, doing the right thing by encouraging companies to correctly respond to the complaints that they received, the consumers who benefited the most from it were the ones who already sort of had a lot of aptitude of the financial system to begin with.
So are you saying that in a way, the regulatory system, CFPB oversight that we've talked about, ends up reinforcing the existing patterns that you've noted rather than addressing them?
Well, yes, in a way. I mean, so I wouldn't say that it was addressing a problem with the financial system, the differences that we documented. But what it does is it really helps amplify the importance of self-advocacy, the importance of supporting documentation, and being able to navigate the dispute resolution process effectively. Those are the types of consumers who were best positioned to benefit from this increased regulatory oversight. And so again, we don't really think it's about ill intent here. It's really about, this is helping the financial system function more effectively by reducing some errors that would have been made on consumer products. And so, but then again, it is about who is able to come better prepared to the table in the first place, that are the ones that are seeing the most benefit from the oversight that the CFPB provided.
Okay. So we're getting toward the end of our program, and I'd like to actually ask the same question to both of you. We'll start first with Charlotte, and then we'll go to you, Raleigh. And that is, what are the takeaways here from the research? What is the takeaway for CFPB and other kinds of regulators like the Federal Trade Commission or the bank prudential regulators? What are the takeaways for the firms that are subject to supervision or enforcement by the CFPB? And what are the takeaways for consumers? So, Charlotte, let's start with you, and then we'll go to Raleigh.
Sounds good. So, yeah, I think the one thing that this research highlights that is critical across the board for every stakeholder here is recognizing that the capabilities to navigate the consumer dispute process aren't really equal, no matter who enters the dispute. So there's a lot of consumer heterogeneity in the ability to navigate this dispute process. And so I would say, starting from regulators, and then I'll pass the ball to Raleigh, I think that here we have to learn that policies and nudging, even when they are made in good faith, even when they do help in the intended direction, they might not have the same effect across all consumers. And in that sense, it's the job of policymakers as well as consumers to kind of design a system where the consumer has enough tools to handle this process effectively. And therefore, that means educating. The consumer needs to get a bit more educated, familiar with these processes. And maybe the filing system could be designed in a way that helps leveling the playing field across consumers themselves.
So do you think that there could be improvements in the complaint portal, that the questions or information that the CFPB is trying to elicit, that could be done in a different manner or worded in a different manner that will enable people who, are less sophisticated, I guess I would say, in articulating their dispute, that would help them more? Is it a design? I don't know if I call it a design flaw, but is there something wrong with that system?
I wouldn't say there's anything wrong with the system. All the tools are in place for the consumer to provide all the information they have. That, again, it seems like the consumer doesn't understand the marginal benefit of going the extra mile. Like, it's not mandatory to attach documentation, but if you do, that pays off. Or it's not mandatory to state your own desired resolution, but if you do and you mention really that you're interested in monetary refund and you have the supporting documentation to do so, that might help. So it might be more about potentially stress that not all elements are mandatory, but certainly disregarding some might not benefit the consumer in the first place. So I wouldn't say the portal in itself is flawed, but we could have a bit more consumer awareness going into it. And the CFPB is having educational programs as well, so that are going to help. So all the little things that are a bit ancillary. I wouldn't say it's necessarily a design flaw. I would rather say there's ways in which the CFPB could help the consumer be more efficient in filing. Or there could be screening processes exposed that then require for additional documentation, for example, as well.
Yeah, or I guess, it just occurred to me while I was reading the paper that some very basic things that could be explained to consumers that I guess could actually be part of the instructions to completing the form would say things like, if you feel that you've lost money as a result of your complaint, you should ask for the money back. Or if you have any documentation that supports your claim, whether it be a copy of a statement you received or anything of any, that might be relevant, you should attach that as to your complaint. Some basic stuff that might help, don't you think?
Yeah, exactly. Yes. I mean, they have the opportunity to do all these things, but sometimes it seems like some consumers don't understand the importance of doing so. So we could stress that in the framing of the different actions throughout the complaint submission process, indeed.
Okay, Raleigh, same question to you. What do you think regulators, firms, and consumers should take away from the research that you and Charlotte have done?
Let's go back to the title of our paper, the hidden cost of financial services. One of the big takeaways that we have from the paper is just that this is potentially just the tip of the iceberg in terms of the cost of the money that consumers are leaving on the table. Right now, we're sort of in a period where a lot of people are really concerned about household balance sheets, just how financially stressed people are. With rising inflation and increased costs of, for example, housing, one thing that's somewhat overlooked is just how much people are spending on financial services. And if we're identifying in our study the fact that people are actually potentially leaving lots of money on the table in terms of items that are on their financial accounts that might merit financial restitution, we're talking about significant dollars that can go back into consumers' pockets. And so one of the also things that we had in our study is just that the dollar numbers and the complaints have grown really substantially over time, and they were continuing to grow at the end of our study. And so we're really looking at potentially hundreds to millions to billions of dollars that consumers are just simply letting go, by not being able to successfully identify mistakes with their accounts. And so we think that this helps open the door for this conversation from both policymakers, for consumers, and also for firms that have an interest in this as well.
Right. So education seems to be key here. And the CFPB does and has, at least in the past, devoted resources toward education, but probably not enough funds. At least that's my observation. And, there's sort of basic things that they ought to be educated about, such as, if you feel that a company has made a mistake or you feel that you haven't been treated correctly, this is how you should handle it. You don't need to go directly to a federal or state agency right away. At least that's not what I do. I usually get on the phone, and as painful as it is, deal with customer service reps. And I very often get the runaround like everybody, even though I think I'm fairly sophisticated when it comes to stuff like this. And, but a lot of consumers, don't really know how to navigate basic things like that. And that can be dealt with, I think, a lot more effectively if they had devoted more resources toward consumer education. And one of the things that it's very timely, considering the subject of our podcast today, I read yesterday that the acting director, Russell Vogt, decided that the monies in the civil money penalties fund that they collect in connection with enforcement matters, which is a lot of money, some of that money is, if it can't be given back to consumers, that's the primary reason for that fund, is to make restitution to consumers, particularly consumers who haven't been treated fairly and the company, has gone bankrupt, or it's a fly-by-night company, it's not around anymore. That's the primary purpose. But a secondary purpose is for education. And CFPB, new acting director, wants to eliminate that. And to me, that shouldn't be eliminated. Anyway, that's just my off-the-cuff reaction. Do either of you have any final remarks, anything you want to say that you feel we haven't covered before we call it a day?
Well, yeah, Alan, I think one of the things that you just pointed out there was that you spend considerable amount of time on the phone with a company trying to get any disputes resolved before you go to the CFPB portal to resolve them. Think about that. That's when we talk about hidden costs, we're also talking about time. This is a considerable amount of effort that needs to go into you helping get the proper financial services that you think that you deserve. And so in many ways, the CFPB portal has helped to streamline this for a lot of consumers and helped actually lower the cost for them. And so that in some ways is in addition to the educational services they can provide, especially in a time when the financial products that people are using are increasingly more complex and are harder for people to understand. And so I think that, this is still providing a really valuable avenue for people who don't necessarily have the time that you do at this point, Alan, to go and actually contact all of your financial services providers, your credit cards, your bank accounts, and so on. This is helping people who don't have the time during the weekday to go and do those things that they would like to do.
Yeah, no, I understand that, and and as can be seen by the statistics and the metrics, that the system has actually worked quite well. I'm concerned about the next 3.5 years, maybe longer, that the CFPB is, been minimalized and doesn't have the staffing, or won't have the staffing that it's previously had, and perhaps won't devote the resources that are needed in order to, basically run a system that works. So, we'll have to see. But I really want to thank both of you, not only for being on our program today and explaining this very valuable research that you've done, but want to thank you for doing the research. Do either of you have any? I guess this will be the final question. Is there additional research that you think should be done in this area? What do you, or is this, in terms of this particular project, is this really concluded?
I think a piece that we're working on is trying to understand, given how it has been trending in the past, how would it trend in the future at this capacity, and how a big of a chunk of the pie of financial service money we're talking about here that it could be getting wrapped up in consumer disputes. So this is one of the things that we're working on going forward, for example.
I'll throw a curveball into this a little bit, is that we're talking about the direct financial services that consumers have with their credit card provider, for example. But I think one sort of overlooked area that would potentially be interesting to intersect with this very well is that now we have a lot of people who are self-professed financial gurus who are promoting their activities on various forms of social media. And so, for example, it would be really interesting for a study such as the one that would connect to these types of problems that people have with their accounts, that would connect back to types of advice that people are getting and the types of education sources, as you mentioned before, Alan, that people have when they're actually deciding what financial services to use. So I think there's that really interesting intersection now between these types of policies and the types of information flow that's out there in the financial services area more broadly.
Yeah. Unfortunately, there are, at least my view, based on my experience, there are a lot of companies out there that claim that they'll be able to help consumers in certain ways, help improve their credit score, help them eliminate debts, and sometimes they're called debt relief companies. Many of them are scams. Many of them don't really help consumers. They just end up costing consumers. And so consumers really have to be careful when they start seeking advice, particularly, if they're over their head in debt. Often they will be taken advantage of by these companies. And these companies, the CFPB and the Federal Trade Commission, have done a pretty good job. They try to, get rid of these companies, but it's like the carnival game whack-a-mole. You can never get rid of all of them. Once new ones seem to pop up all the time, and companies disappear, and then the same management of that company opens up a new company under a different name. It's very, very difficult to track them. But anyway, thank you again. Really appreciate your being part of the program today. And if there's further developments based on the research that you've done, please stay in touch, because there might be some interest in doing a follow-up program. So thank you, Charlotte. Thank you, Raleigh.
Thank you. It's a pleasure to talk to you.
Thank you so much, Alan.
Yeah. And to make sure you don't miss any of our future episodes, please subscribe to our show on your favorite podcast platform, whether it's Apple Podcasts, YouTube, Spotify, or wherever you listen. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the consumer finance industry. And if you have any questions or suggestions for our show, please email us at podcast, that's singular, at ballardspar.com. Stay tuned each Thursday for a new episode of our show. Thank you for listening, and have a good day.